The year was 2018. Fear and uncertainty grabbed Dalal Street once again. All the gains Nifty made in 2018 was gone. You have invested for a long term in the market, and now the market has crashed. Investors are struggling to hold on. They are suggesting you to buy low. What makes you so sure that the markets are going to go up? What makes you so sure that you will recover your lost capital? What now? A market crash is a worst fear for any investor. Gains over the past couple of years gets wiped out in a couple of minutes. The portfolio goes in red. Nifty started 2018 at around 10,500 in January. Fast forward to August 2018, it crossed 11,500 and to reach an all-time high of 11,700. 2 months later, it's back to where it all started. Nifty fell to as low as 10,000, 5% down from where it started in January 2018, 14% down from its all-time high in August. In other words, all the gains that Nifty had gained in 2018 was gone in a month. 2018, a year not in the limelight. Not in the limelight like the 2000, 2008, the pandemic 2020. Not everybody discussed about this year, but yet it is still horrific. 14% of your portfolio's worth has gone down, but nobody was talking about it. It was still devastating. The market pros are still sitting tight on their portfolio. The vast majority of the new investors who have just started investing, they are terrified after this crash. They are terrified seeing their portfolio in red. Nobody wants the market to nosedive. Nobody wants it. But that is a phenomenon which is inevitable in the market. Like any other financial instruments, mutual funds too takes this inevitable hit from the market. The performance of every mutual fund takes a hit. On the contrary, even with this massacre, market experts would count on their experience and they would say this is not the time to exit the market. In fact, it's time to buy more. It's not that simple, is it? You need to know why the market is falling. You need to know why the market has fell down. You need to know the behavioral impact behind this fall. You need to know the long-term correlation between the market and your investments. You should understand the discounted pricing method. You should understand the distinguished differences between the lump sum and the SIP method of investing. In this video, we'll see how mutual funds take a hit during a market crash and how you can understand its pattern versus its relation to your investments. Knowing this can only allow you to take an appropriate action. Investing is tricky, isn't it? I always say this, investing is tricky. Every step you take in the financial world is a challenge. And with those challenges comes the next big opportunity. This video will give you an insight, but the next one I post can bring you that next big opportunity. So like this video and subscribe to this channel right away because you don't want to miss it, do you? First, understand the reason behind a market fall. As an investor, it is very essential for every one of us to know why the market is falling, to know why there was the 2000 dot-com bubble, to know why there was the 2008 crash, why there was a huge dip in 2020. We all know the reasons. It's very important to know why. Crashes can happen due to numeric reasons, due to weak economic indicators, macroeconomic numbers, global cues, falling rupee value, crude oil prices, IL&FS crisis, and so many defaulters, so many reasons. But what's worth noting is the state of the economy. Is it growing or is it just falling apart? All the other reasons are petty reasons and they would subside down. They would just simply be compressed beneath the massive economic force, if that is in the positive direction. And of course, it's vice versa. Any small uplifts can just be nullified and subside down if there is a massive major downfall in the economy. With a healthy economy, sooner or later, the bulls will be back in action, and that too with an improved increased strength. Not uncommon. Now with the growing economy, these crashes are not uncommon. They are very common. They do come and they will come again in future.
Stay here. I'll be back.
Now the major reason for the fear and insecurity happens when the new mutual fund investors who have invested in the last couple of years, 2-3 years, they haven't seen a major crash coming through. And when they see something for the first time in their life, they have put in a small amount of money just to test the market, to understand the market, and they see a crash, their portfolio goes red. What they have put in, the final value shows less. That's when they start panicking. But if you see the historical charts of the market, you will see such crashes are not uncommon. Change is the only constant, and the rise is followed by the fall and vice versa. And that is the life cycle of the markets. The calculation. What happens during a market crash is the stock price and the NAV price, they fall. Now let's see this with an example. Let's just suppose a fund's NAV is at rupees 50 and you have 1000 units of that fund. So your total investment value is 50,000 rupees. Now say after the crash, the NAV value has dropped down to 40 rupees. Now your investment value is 40,000 rupees. This happens because the underlying asset in a mutual fund comprises of stocks in different companies. Stocks of different companies. During a market crash, the stock prices, they come down. When the stock prices, they come down, they in turn pull the performance of the mutual fund down. And hence, the NAV price starts falling. These companies, they too take a hit with their operations taking a hit on the economy, taking a hit of the falling market. It will take time for these stocks to recover back. When that happens, the mutual fund holding these stocks would give you the returns back to you. The NAV price would start rising again. The performance of the mutual fund would increase once these stock prices, they recover their lost ground. So what should be your approach? While market crashes invariably pull the market down, pull the mutual fund performance down, as an investor, you need to remain patient and not exit the market. If you redeem your investments now, you are actually encashing your notional loss into actual loss. You're realizing your notional loss into actual figures. Mutual funds are long-term investments. It's important for you to remain calm for the entire journey. You need to stay invested and take advantage of the rupee cost averaging. Markets have always rewarded those who have not pulled out their investments from the market. Equity funds can take years, maybe 5-7 years to recover their lost grounds. And that's why it's important to hold on, to stick to your investment goals, to stick to your investments for that longer period of time. As long as you're thorough with your investment when you first invested in the fund, if you have done your research right, if you have done a thorough study, you need not worry. And finally, buy units at a discount. Finally, when everything stays well, you know you have to stick around. What you can do is keep buying units, purchase more at a discount. If you have spare money sitting idle in your account, purchase more units when the market is down. If you understand the concept of rupee cost averaging, this shouldn't be a problem for you. While it might look crazy, it might sound crazy, but already lakhs and lakhs of investors are already doing this. So then, if I'm saying buy at dips, then what is the best approach? Is it lump sum or is it a SIP? Just close your eyes and do a SIP. That's it. Why so? Why so? Because the reason is SIP instills the discipline for you to keep and stay invested in the market. And lump sum allows you to buy at market dips. So your SIP continues to buy units on a regular basis. Over and above that, if you have some fund lying idle, go ahead, buy some when the market is at its very, very bottom. A large number of investors, they often try to find answers while trying to invest in mutual fund, invest in the market. But trying to time the market is not a very good approach towards investing. Worrying about a rise or falling market will only and only add tensions and psychological pressure in an investor's mind. Keep your mind clutter-free. Take the boring approach of setting up a SIP, shut it and forget it. Take the disciplined approach to investing. Focus on your overall final goal. Focus on your portfolio goal. Focus on the fund's performance and your final objective. This playlist here will take you through to the next steps of what you should be doing. It's a must watch for any investor. Go ahead, click on it right now. As of this video, adios.